What's up, everybody? Okay, welcome to the exam breakdown. Today is Wednesday. It is January 22, 2025. Man, 22. Like, this month is flying by. Things are just moving. Everything just moves faster. I always tell my wife this. I'm like, man, after we had kids, if any of y'all have kids, things move a lot faster, it seems, when you have them. It's like a time warp. They're celebrating birthdays way too quick, in my opinion. The kids are just growing. It's just crazy. Hope you guys are doing well. Thank you very much for tuning in. If you're not with us live, not a big deal. To the world watching us live today. Ain't no one watching us live today, man. There's like 3 people on and my 3 diehard fans, and I hope you enjoy this. But if you're not here, thank you for checking it out. You can watch the replays later. My name is D. Kumar. It is my mission. It is the channel's mission to help you get through real estate and mortgage financing examinations in this particular iteration of what we are doing to help you get through, to eliminate the drag, to take away the non-essential pieces of information that you really don't need, and to focus on things that you are going to need to be able to get through this examination. Now, obviously, of course, it is my intention and expectation of all of my students to hopefully serve in the most ethical and moral ways. You get licensed, you do what you're supposed to do, especially when you're dealing with the financing, structuring of other people's lives. It's a very important job, the loan origination business. And if it's done well, I'm telling you, I know a lot of top producers, and I know the ones that are just crushing it and making fortunes, and some of these numbers are so jaw-dropping and staggering, it would blow your minds when you get to see them. Check out things like, the Scotsman Guide and everything else, and you see all these top producers, these mega producers, and they're making fortunes. And, when you get to know them, you see this huge level of ethical tapestry woven in between their professionalism and their understanding of the marketplace and their ability to sell and their ability to serve others, and etc. So once you have all of these elements of the stool, you become quite a formidable force of nature when it comes down to being successful at this business. If you do this business right, this business will treat you right. It is such a great business to get into. And now, without further ado, let's get into it. So today's topic at the exam breakdown, and the format of this show basically really is to kind of give you like a lunch break. Hey, during lunch, maybe you're thinking about quitting your job. Maybe you're thinking about reorganizing. Maybe you might have to reorganize, right? Maybe you're going to lose your job. And I will tell you that it is critically important to be able to understand how to do this business, understanding finance, understanding how to do functions inside of mortgage financing is essential. It's one of those job skills that are very, very, very tough to take away if you're worried about losing your job to an AI. I know a lot of folks are. I've talked to a lot of people. They're nervous and they're sweating it. Can you make a lot of money doing this? Of course you can, despite how many people there are. It is hard to get past this examination, and that's the goal today. So let's do this. For a little while, let's say about 35 minutes-ish, plus or minus, I'm going to go through some topic, and I'm going to go through some questions, and I'm going to see how you guys do with it. Today's topic is a very critical topic. It falls under multiple sections of the SAFE outline. Let me just pull that up. So what we're looking at today is predatory lending. And predatory lending, although it is a little line in the sea of topics that you need to look through, and I'm sure all y'all are looking through this at the NMLS site, and you're looking at the content area, and you see the federal mortgage-related laws, for example, is 24% of the exam. The uniform state content is 11%. Ethics, 18%. Now, ethics has a lot of interplay in the world of general mortgage knowledge. Ethics has a lot of interplay with uniform state content. Ethics has a lot of interplay with the federal related mortgage laws, and ethics has a lot of interplay with the mortgage loan origination activities. As a matter of fact, ethics is this hinge, and 18% of this examination has something directly to do with some ethical quandaries. Now, if you roll down, ethics and predatory lending have something to do with the Real Estate Settlement Procedures Act, has something to do with the Equal Credit Opportunity Act, has something to do with the Truth in Lending Act, as it is an anti-predatory lending law. It has something to do with the disclosure concepts of TILA, integrated disclosure, And it has something to do with the Home Mortgage Disclosure Act, HMDA, the reporting law. It absolutely has something to do with all of these laws. The Dodd-Frank Wall Street Reform Act, it was written to eliminate predatory lending practices that were not aligned with protecting the consumer base. The Consumer Financial Protection Bureau is all about scoping out, rooting out predatory lending practices and quashing them. And then the SAFE Act, which is the reason why all of you are taking an examination if you're working for a state licensed entity versus a federally chartered institution. As you know, if you work for a large, institution like a JP Morgan Chase, then you don't have to get your loan originator's license, although a lot do, in case they want to go there and then jump to somebody else. And then, you might end up going to another organization and they're state licensed. And even large organizations like UBS Financial Services, the behemoth, wealth management operation in the United States, their mortgage lending divisions are all state licensed entities, by the way, because they don't have a federal charter. So subjecting their loan originators to the requirements depending on where they have been filed in the hierarchy of UBS. So when you're looking at all of these folks, predatory lending is a huge issue, and it kind of has this interplay. Now, it's all the way down, okay? Prohibited acts and practices and compliance, and then general mortgage knowledge. I'm just going to go all the way to where it is sitting in the outline. We're going all the way down into the ethics section. Remember, that's 18% of your exam. And then predatory lending ends up falling right here. Predatory lending and steering. Now, there's a lot of potential questions when it comes to predatory lending, and I want to jump into those. So really what I want to do today is I want to cover predatory lending, and then I want to give you a couple of questions and then go through it. So if everything's good, then what we're going to do, we'll be in and out of here. No one's going to know, none the wiser. We're going to try to work on predatory lending specifically and take a look at a couple practice questions or samples just so you understand what's going on. So first off, let's get a working definition of this. Predatory lending involves unethical practices where lenders will take advantage of a borrower by imposing unfair and abusive loan terms. Now, prior to the passage of the Dodd-Frank Wall Street Reform Act and the anti-predatory lending provisions of the SAFE Act, predatory lending was a common thing. You have to understand, prior to 2008's economic crisis, no licensing was required of loan originators. Licensing was required for all kinds of stuff. As a matter of fact, I jokingly say this, I don't mean this in an insulting way in any way, but you have to get, if you want to touch somebody's hair and be a hairdresser, in states you have to be licensed to touch people's hair. And you have to spend a lot of time in many states studying the art and the science of the manipulation of hair in order to be licensed to do such. And yet, before 2008, you didn't have to be licensed to originate multi-million-dollar loan transactions and advise people on financial matters where you had no expertise in the first place. So predatory lending, one of the reasons why everything kind of went so bad is because there was no no stopgaps, there was no licensing. And then after 2008, when the Housing and Economic Recovery Act was passed, shortly after that, they passed the SAFE Act, the Secure and Fair Enforcement for Mortgage Licensing, the licensing law. And it by itself rooted out a lot of folks that couldn't get licensed because they might have had a criminal past, they might have issues, we need standards, so they need to pass a test, etc., and that's why you're here. So predatory lending is really one of the roots of this entire experience that you're going through today compared to 2008 and prior. Typically, these practices include excessive fees, high interest rates, and terms that can trap a borrower in debt. Often targets that are vulnerable and populations as such. So the reality of predatory lending is that it still exists today. We have a much better understanding of how it operates. And, joking this at the beginning of this, I mentioned losing your job to AI. One of the things that AI is doing, as a matter of fact, is helping to identify in real time, basically, if there are redlining behavioral practices and things of that nature, which, could be inadvertent to a large lending institution that they might not even realize that they're doing some certain things. And at the end of the day, these, algorithms and artificial intelligence is helping to detect these things, just so you can understand. All right, so characteristics of predatory lending: excessive fees that add to the loan cost without being justified by the borrower's credit risk. We reduced this burden on consumers by eliminating things, passing consumer protection laws like the Real Estate Settlement Procedures Act, which avoids kickbacks. Excessive fees and kickbacks went hand in hand. If you give me a referral for a loan, I want to pay you back for that. And really, it's not like you're paying them back for that out of your pocket. What ends up happening, I'm saying a hypothetical pocket, not you specifically, but what ends up happening is that, if you get a bunch of referrals from somebody and they're giving you a bunch of deals, well, you want to reciprocate, right? Reciprocity is a big thing when it comes to sales. Read tons of books on sales and marketing. You'll understand what reciprocity is really all about. Dr. Robert Cialdini says it best with reciprocity, by the way. But when you look at this from that perspective, the way that the industry sort of catered to paying kickbacks was, hey, look, the consumer really doesn't understand what we're charging them for all of these things. Why couldn't I just, instead of a $500 processing fee, what do I just kicked it up to $900, right? It's none of this is understood anyway. And then the consumer can pay the extra, $400 or $500, and then I'm just going to take that and just give that to my referral source, and I'll give them $500 a loan, and that's how we're going to do it. So they kind of pass the buck to the consumer. The consumer didn't know about this, and again, excessive fees that are added to the loan cost without it being justified. Appraisers, before all this legislation, were just padding their fees. Title attorneys, not all of them, but people were doing this. This isn't like there's 2 people doing this. So many people were doing this, which is why everything went so bonkers. Aggressive sales tactics like door-to-door solicitations, misleading advertising, and pressures to sign on the spot. Many times, lenders will do in-home doc appointments, and sometimes borrowers might have felt coerced into signing documentation that they just didn't understand. States and the federal government has laws against coercion in going forward with transactions. That's why, as you're learning, you have 3-day right of rescission on a refinance home loan and things like that. These fail-safe mechanisms to help consumers make sure that they don't have buyer's remorse. Loan flipping, where the lender encourages a borrower to refinance repeatedly, earning fees and points each time while the borrower gains little or no financial benefit. Now, just as an aside, some of y'all might be thinking, well, it's not like that anymore. Why do we still have to learn this stuff? And the truth is, it's not like that anymore, but it could become like that again. And if it does, if we unratchet this or take apart that or look under the hood of this, then you might find that things kind of come back to this average mean where history could repeat itself. And if it does, then enforcers, attorney general's offices, regulators, the CFPB, if they exist, are going to be able to have this understanding of what to do about it, because before that, nobody really knew what to do about this stuff. Common predatory loan features are things like balloon payments, which I would guarantee is something that you might see as practice questions. I would double check that. Negative amortization. You definitely want to know the definitions for full amortization, partial amortization, and negative amortization. Negative amortization increases the loan balance because payments covered only a part of the interest. So you're not even paying interest only, you're paying below interest, and the unpaid interest is added back to the loan. So you end up owing more potentially than when you started. High-cost home equity loans that strip borrowers of their home equity while providing little or no economic benefit, which is one of the things that you might be learning about. We talked about it last week or the week before, was the ability to repay rule, the ATR rule. And that rule also goes hand in hand into high-cost lending and the ability to repay the debt to make sure that the consumer can and it's in their best interest. And again, this isn't a sermon, okay? Like I've taught this for so many people. And a lot of people, when I teach them, get upset because they're like, I'm not doing this stuff. This is ridiculous. Why do I have to know this? Well, number one, it's part of your exam, number one. So if it's for nothing, understand what these terms are to get through your exam. And number two, it's because the understanding of ethics will continue to bleed through your career, and you need to understand this stuff. Regulatory framework against predatory lending. Number one, an anti-predatory lending law would be the SAFE Act. You want to know what SAFE stands for? The Secure and Fair Enforcement, for Mortgage Licensing Act. So the SAFE Act is all about mortgage licensing, was enacted to enhance consumer protection and reduce fraud by setting minimum standards for the licensing and registration of state licensed mortgage loan originators. So if you're taking this course, if you're watching this video, if you're about to take the test, if you're required to take the test, it's because of the SAFE Act. Also, as an aside, you want to know the penalties for violating the SAFE Act, so definitely look them up. They do change, the numbers are represented. If you go to the NMLS's website, they'll explain if penalties do change when you will be tested on those. So definitely check their site. It's a wealth of information, by the way. There's tons of information there to help you out. Truth in Lending and HOEPA are two other examples. The TILA law stands for Truth in Lending Act, and HOEPA is the Home Ownership Equity and Protection Act. HOEPA has been around for a very long time, by the way, and they're designed to prevent practices considered predatory, like underdisclosed balloon payments or incentives for repeat refinancing. HOEPA is a law that requires various things, like you can't have no prepayment penalties, for example, on a high-cost loan. High-cost loans and HOEPA go hand in hand. So there's prime loans, which are loans made to the most qualified borrowers. Then there are higher cost loans, and a higher cost loan could simply be a more expensive loan because the loan amount is large. It could just be a jumbo mortgage. It doesn't mean that the borrower is less prime. It just means that there's more to borrow, and you're borrowing more. It's sort of this economy of scale, and therefore the charges are based off of, many times origination charges are based off of, can only be based off of the loan amount. So therefore the origination fees are going to be significantly higher. Okay. And when they are high cost loans, and that's why they wrote HOEPA. HOEPA was the Home Ownership and Equity Protection Act. And there are state-specific regulations that also apply, but what's interesting about the originator's examination is you're not going to see state-specific laws. You will see the uniform state test. In the states that are, which is virtually every state, has adopted the uniform state test, which is something that's sort of more unilateral across all of the states that they have adopted and sort of codified into the way that you're supposed to learn this stuff. The role of the mortgage loan originator. So MLOs have a duty to act in the best interest of their clients, ensuring loans are suitable, affordable, and transparent. Ethical MLOs avoid any practices that could be construed as predatory, such as hiding terms, not disclosing the full cost of loans, or misleading clients about the benefits of certain loan products. An interesting thing that happened with the Dodd-Frank Wall Street Reform Act, in Section 14 of the Dodd-Frank Wall Street Reform Act, that called for mortgage reform. And inside of the sort of the galaxy of mortgage reform, you found that they said you can loan officers can no longer get double commissions from the lender, commissions from the consumer, and they can only get one, and that the yield spread was the consumers, and your charges are your charges. And those numbers, with exceptions to the change circumstances rules, it cannot change from the initial loan estimate to the closing disclosure. And so prior to all of this, loan originators would be incentivized to, let's say, sell a negative AM product, like an option ARM product or something. Look those up. You'll find them on Google that, and you'll see what I'm talking about. But an old, amazingly interesting product was this product called the option ARM, or sort of this deferred interest kind of style loan that had negative amortization. And they were very, very, they looked really favorable to consumers because their interest rates would start you out at 1%, and then they would go up and then up, and they gave you minimum payments like a credit card. So you had options. That's what they call it, the option ARM. It was an adjustable rate mortgage. And by its face, it was the financial product was fine. It just was in the wrong hands. It wasn't a good idea to the wrong consumer. And however, the incentive was you would get 5 points, 5% of the loan amount if you would sell an option ARM. You would make 1 or 2 points if you sold a conventional 30-year fixed mortgage. So there was a profit motive to steer people and push people into a product that the loan officer made a ton of money. I mean, if you originated a $500,000 mortgage loan, you would make $25,000 on that, and you can close 10 of these a month and make $250,000 a month, which was like nothing back in the heyday of the business. And again, probably 90% of those loans shouldn't have gone to those particular consumers, and those particular consumers should have just gone into a 30-year fixed mortgage, right? So that's where all of this is coming from. Misleading. Spotty predatory lending practices, looking for red flags such as unclear loan terms, rates are significantly higher than those offered by competitors, or terms that penalize borrowers for early repayment. Educate clients about the importance of reading and understanding every part of their loan agreement. These are all critical pieces that they could construct questions out of for these exams. Legal consequences of predatory lending: fines. There are mega fines. Lenders found guilty of predatory lending practices can face substantial fines. These fines are intended to deter lenders from engaging in unethical behaviors and to compensate for the oversight required by regulatory bodies. Now, states have the enforcement authority, and so does the Consumer Financial Protection Bureau. And if it's a big enough lending institution, the penalties and fines are massive. They run in the millions. During the economic crisis, they were in the billions. Like, whoa. So huge sanctions. Revocation of licenses. MLOs and their employing institutions can have their licenses revoked for predatory practices. As a matter of fact, the lender can have their license revoked if their loan officers are engaged in predatory practice potentially. This effectively bars them from participating in the mortgage lending industry, serving as a severe penalty for non-compliance. And then criminal charges. In extreme cases, individuals involved in predatory lending may face criminal charges. These charges can include fraud, especially if deception was used in the process of originating loans. So unfair, deceptive practices and abusive practices, UDAP laws, consumer protection violations. The locals, the states can go after these folks and really, really go after them in a hard way if it's warranted. Best practices. So these are your sort of true north stars, if you will. Always prioritize the borrower's ability to afford the loan based on their financial situation. Remember, there could be changed circumstances. Maybe the borrower in the scenario of the test question didn't tell you that they just got fired. Maybe this is an ethics question in that way. Maybe they're withholding information about certain things. Maybe they have undocumented income that they're trying to pass along, or unseasoned funds or something like that. Ensure full transparency in all dealings. Clearly explain all terms and possible consequences of the loan to the borrower. Stay up to date on updates to lending laws and ethical practices. Stay informed on best practices and legal requirements. Nothing serves you better than to work amongst professionals that do place a lot of effort in their infrastructure to make sure that predatory lending is not ever something that would happen in their organization. Make sure that you align yourselves with these organizations and be leery of organizations that put this in the back seat. Again, a strong company that does really well financially for its loan originators, providing years and years of wonderful income for you, and taking care of consumers. Make sure that you're aligning yourself with the right folks. There's still a lot of less than awesome folks out there in the business, but be leery. All right, let's hit some questions here. Which of the following best illustrates predatory lending practices? Letter A, offering the lowest possible interest rate to the borrower. Letter B, offering the borrower an ARM because they anticipate a pay increase in the foreseeable future. Letter C, charging excessive fees that do not correspond to the borrower's credit risk. Letter D, encouraging early loan repayment to save on the total amount of interest. And the answer, letter C, charging excessive fees that do not correspond to the borrower's credit risk. So which of the following best illustrates a predatory lending practice? Now, letter B is interesting, right? Offering the borrower an ARM because they anticipate a pay increase. So some folks might consider that to be sketchy, but it's not. You're in the financial advisory services as a loan originator, and you're making recommendations, but it's saying here that offering a borrower an ARM because they anticipate a pay increase. So in that particular situation, they're expecting a pay increase. And that's fine if they're expecting a pay increase. And they might say, oh, so then in that case, if you're expecting a pay increase and then you'll be more affordable, then maybe we explore a few, adjustable rate products that we have. The rates are lower than the fixed rate non-callables. However, I'm going to present to you a spectrum of different choices. And if you have questions, I'll be happy to answer them. Ultimately, these are decisions that we need to make sure that we vet with them and they understand the nature of their consequences and the actions. Under the Home Ownership and Equity Protection Act, or HOEPA, Which practice is considered predatory and is specifically prohibited? Letter A, requiring the borrower to maintain extra reserves beyond typical lending practices. Letter B, charging prepayment penalties on high-cost home loans. Letter C, failing to provide an amortization schedule for loans that include terms allowing negative amortization. Letter D, offering high-interest short-term balloon payments unless certain consumer protections are met. And the answer? Letter B, charging prepayment penalties on high-cost home loans. So this is considered predatory and is specifically prohibited under the Homeownership and Equity Protection Act. Now, look at these other answers. Failing to provide an amortization schedule for loans that include terms. So listen, is that potentially a violation? The answer is yes, but it's not specifically prohibited or considered predatory under HOEPA. It is a problem for lots like states for sure. You know, if you look at, like, for example, where I am, CMR 940 8.6, which is the subsection of where the predatory practices lie inside of or prohibited practices for loan originators in like Massachusetts. All of that stuff is covered, like if you don't properly disclose documentation and stuff, but they're asking you specifics to HOEPA. And that's why test questions like this are useful to practice with folks that know how to do this stuff, because you know it's important to be able to see that. Requiring the borrower to maintain an extra escrow reserves. Well, as a matter of fact, high-cost loans and higher-cost loans do allow for a bit of an expansion to escrow accounts, and so A is okay. Offering high-interest short-term balloon payments unless certain consumer protections are met. Well, that's just a weak sort of statement based off it, and that's really where they were trying to catch you here is with the phrase high interest, short-term balloon payments. But really, at the end of the day, it's about charging prepayment penalties. So good question. Which regulation requires lenders to provide borrowers with timely and comprehensive disclosures about the costs and terms of their mortgage? Letter A, the Dodd-Frank Wall Street Reform Act. Letter B, the Fair Credit Reporting Act. Letter C, the Equal Credit Opportunity Act. Letter D, the Truth in Lending Act. And the answer is letter D, the Truth in Lending Act. All right, so providing borrowers with timely and comprehensive disclosures about the costs and terms of their mortgage, the Truth in Lending Act and the Real Estate Settlement Procedures Act go hand in hand and come up with this thing called the TRID rule. As you've learned in the past, or hope you're learning for your exam, TRID stands for the TILA, RESPA, Integrated Disclosure Rule, and the two big documents there that you really, really want to know about is the loan estimate and the closing disclosure, and both of which, and the additional supplemental disclosures required under all of these laws, try to clear up what's going on. But those laws, under the Truth in Lending Act, are really about the timely and comprehensive disclosures of costs and terms. I'm going to jump to this one. Which of the following actions can the Consumer Financial Protection Bureau legally undertake against a mortgage lender found to have engaged in deceptive practices? Letter A, recommend the suspension or revocation of the mortgage loan originator's license. Letter B, order restitution to consumers who were harmed by the deceptive practices. Letter C, refer cases to the Department of Justice for criminal prosecution. Letter D, all of the above. Which of the following actions can the Consumer Financial Protection Bureau legally undertake against a mortgage lender found to have engaged in deceptive practices? And the answer, letter D, all of these are at the disposal of the enforcement divisions and the regulatory framework and the bodies, the CFPB, and all of the state-specific enforcers, like the Division of Banks, the Department of Financial Affairs, and et cetera. Every state has their own sort of CFPB that oversees their state-specific lenders, brokers, et cetera, and folks in the financial sector. And then we have the Consumer Financial Protection Bureau, of course, which is another, is the big one created by the Dodd-Frank Wall Street Reform Act. All right. So going through this focus a little bit on some of the definitions of predatory lending. Things like excessive fees, improper disclosures, ethics generally speaking, junk fees. Think of things like balloon payments, prepayment penalties, negative amortization, risky loan features. The counterbalance to those are things like qualified mortgage rule, ATR rule, like the ability to repay rule, Truth in Lending Act. Also remember things like in these laws, they are consumer protection laws. They were designed, for the most part, to identify if anything was happening to a consumer that shouldn't be, if the consumer was being treated clear and conspicuously with transparency and ethics. Really, at the end of the day, that's what all of these laws kind of are. If you really looked at them from the highest of levels, that's really what they are. Give me an example of a anti-predatory lending law. The SAFE Act, the Secure and Fair Enforcement for Mortgage Licensing Act, is an anti-predatory lending law because it requires folks to get licensed and to go through all this training and stuff. And that's a way that we drop predatory lending, because then we don't have possible predatory people making financial decisions for folks where they don't have they lack the requisite abilities to qualify for licensing, right? Criminal backgrounds or et cetera. So SAFE Act is an example. Truth in Lending Act is an anti-predatory lending law. The Home Owner and Equity Ownership and Equity Protection Act, HOEPA, which, by the way, lives inside of the Truth in Lending Act. It's a law inside of a law, right? To confuse the matters more, but HOEPA lives inside of the Truth in Lending Act. So remember, with Truth in Lending, there's prime loans, there's higher cost loans, and then there's these high cost loans. By the way, for y'all studying, you're going to want to know your HOEPA triggers, your high cost loan triggers, 8.5, 6.5, APOY. You're going to want to learn all of those. And also for the high cost loans, the Section 35 loans, you're going to see those potentially on exams. I would test you on them. And that's the understanding of what predatory lending is and sort of how this whole thing works. As you're studying for this with ethics, I would read through the answers of the ethics questions first and then go back and read the question. You're going to find that a lot of these ethics-based questions on exams, this exam and many others that I've coached people through, you're going to find that the answers almost jump out at you. You are able to parse through the answers, look for similarities, look for positive statements versus negative statements, kind of sort through your answers, and then go back once you've taken a few moments to read the answers, go back and then first read the question. Don't read it first. Read it usually second. And if you do that with ethics questions, you yourself can formulate directions of where the question writer might take you. And it's very, very helpful to be able to take tests that way. The answers almost jump out at you. And if nothing else, the wrong answers almost clearly jump out with you. And then you're kind of looking at the questions and then you're validating, right? And I think that that's one of the best pieces of advice that I can give you. It works like a charm. All right. Hopefully this is one of those topics that's like there, it's peppered around, and hopefully you'll be able to just nail these to get to that passing mark where a lot of students that I hear kind of get right to the edge of the cliff and then they kind of falter. And as you all know, if you fail this examination, then you have to wait 30 days to take it again and again and again. And the third failed attempt, then you have to wait 6 months. So there's like this barrier to entry just in the sort of the mortgage process in education that's really important. Anyway, I hope spending a few moments with an educator that understands the content has helped you. For those of y'all that are subscribing to the channel, thank you very much. For those of you that are new, welcome. Thank you for checking out this stuff. Thank you for helping us grow our channel. If you haven't subscribed, please do. Also, we're offering a couple of really useful tools for the real estate licensees. We've got a free exam that you can download. You just got to give us your email, and I might send you some emails. Really, the emails that I send y'all are just trying to be helpful, give you tips and advice, and occasionally I'll throw a couple, hey, we just came out with this book, check it out if you want to, it's available on Amazon, try to help me feed my kids. And that's really the long and short of it is, but it's not hard sells on anything. We're just here to help. I've been teaching people for over 30 years. It's just teaching to me is very important. And I know what it means to have someone help you, guide you through, helping you get through something that might be a little tricky, and then seeing you off to the next level. So please, please, I hope this stuff helps. If you have any comments, if there's anything that we can do that you want to learn about that we can help you with, please leave it in the comments. And thank you very much. Good luck with your studies. Exam breakdowns happen every Monday. Exam breakdowns happen every Wednesday. Two things that we do. On Mondays, we go through for the real estate licensees. We go through brokers and salespersons all over the United States, everywhere, anywhere, anytime. This stuff is going to help you pass. And then on Wednesdays, we help the loan originators that are trying to get through this examination. So Mondays and Wednesdays, join us live. Ask us questions. It'll be cool. It'll be nice to actually have people to interact with. If you don't, just make some comments. We'll see if we can help you out with those as well. Good luck with your studies. Good luck on your exams. And I will see y'all in a week.